Hello and welcome to Startup Street. I'm Ritu Singh and with me is Arundhati Ramanan. Here are the key headlines from the startup space. Quick commerce company Zepto updates its filings for an IPO, hopes to raise more than 8,000 crore rupees. The filings reveal Zepto's founders Adit Palicha and Kaivalya Vora were summoned by the Enforcement Directorate seeking details on foreign investment and overseas investments.
ChatGPT maker OpenAI joins Anthropic and SpaceX in the dash to Wall Street, files for an IPO through the confidential route while details remain under wraps. Reports suggest OpenAI is targeting $1 trillion valuation. The public offering is expected to launch by September.
Perplexity CEO Arvind Srinivas tells CNBC that the AI firm is planning to go public in 2028. The CEO's comments come after Anthropic confidentially filed to go public, and as investors assess the performance of the upcoming SpaceX IPO, Srinivas said that he thinks the IPO of Anthropic and a reported listing of OpenAI is going to be well received.
ACO is preparing to file IPO papers by September, targeting a $300 million issue and $2 billion valuation as investors assess the insurer's growth trajectory amid a recent high-profile CMO departure.
With the incredible capabilities we introduced today and so many more still to come, I truly believe the best is still ahead.
And Tim Cook delivers a farewell message at his final developers conference as the CEO of Apple. The tech giant unveils a rebuilt Siri that's powered by Google's Gemini, along with new child safety and parental controls.
Those were the headlines that we're tracking for you this evening. But on What's Brewing today, it's a CNBC-TV18 news break that's confirmed. Quick commerce player Zepto has filed an updated draft red herring prospectus with the market regulator. The company is looking to raise over 8,000 crore rupees through a fresh issue of shares. Rachna Dhanrajani joins us now with all of those details. Rachna, what are you learning about Zepto's IPO plans and the key risks that investors should watch out for?
Zepto has filed its updated DRHP with SEBI. We had first reported about the size and the offering of the potential IPO back in December 2025, subsequently when it got the green light from SEBI. And today, all of it is official in line with what we had reported. The fresh issue is of about 8,000 crore rupees, an offer for sale of 11.34 crore shares, and the total expected raise between 11 and 12,000 crore rupees. Nexus Venture, an early investor, is one of the biggest participants of the OFS, and notably founders are sitting out of this one. Now, in FY26, the company's revenue came in at rupees 22,624 crore rupees, more than double of FY25, which was around 11,000 crore rupees. But net loss widened to about roughly around 6,000 crore rupees from 4,700 a year ago. Let's zoom into the latest quarter. Q4 FY26 revenue was at about 7,500 crore rupees, which was up 75% year on year, and net loss narrowed to 1,500 crore rupees from 1,800 crore rupees a year ago. Now, the company is processing 23.3 lakh orders a day across 1,139 dark stores. Revenue is scaling fast, but losses are narrowing by the quarter but are widening by the year. At least that's what we can see in the DRHP now. Put that alongside the competition. Blinkit reported Q4 revenue of 13,000 crore rupees and turned adjusted EBITDA positive at 39 crore rupees. The only one in the space right now with a positive EBITDA. Zepto at 7,500 crore rupees in Q4 revenue, which is roughly half of Blinkit's scale, with an adjusted EBITDA loss of roughly 1,200 crore rupees. Swiggy Instamart is further behind at around 1,000 crore rupees in revenue and an adjusted EBITDA loss of about 858 crore rupees. Zepto is ahead of Swiggy, but it lags behind Blinkit. Now to the risks. The ED issued FEMA summons to both founders personally in April. This year, both appeared before the Enforcement Directorate. Now, the matter is ongoing as of the filing date. Separately, there's also CCI that has an active anti-competitive pricing inquiry against Zepto. Both of these cases remain unresolved going into the IPO. So the growth story here by the numbers is real, but so are the regulatory clouds.
Okay, in what's brewing, we have electric two-wheeler manufacturer Simple Energy, which has raised 250 crore rupees in a mix of debt and equity. The majority of the proceeds will be deployed to scale up production, including manufacturing and capacity expansion, while the remaining will be used across sales, marketing and R&D to strengthen the product roadmap and customer experience. Simple Energy currently operates at a capacity of 3,000 units a month. It is targeting monthly sales of 10,000 scooters by March of 2027, which is up from about 1,500 a month currently. So let's bring in Suhas Rajkumar, founder and CEO of Simple Energy, for more on the company's growth plans ahead. Suhas, welcome to Startup Street. Thanks for your time here. Start by telling us about this 250 crores that you raised in a mix of debt and equity. For the equity portion, what kind of valuation did this round come in at? And, what the exact mix was? And also, what kind of milestones are your investors expecting you to hit before you get to your next fundraise?
Thank you for having me. Good evening. So we raised this round with our existing investor, Tharocare founder, Dr. Velumani sir, and we also participated, me and Ankit Gupta, who is my co-founder. So this entire is about 126 crores in equity, and the rest of it comes on debt. And the valuation per se, it's a continuation of the previous round, although it is called a Series B today. So this is primarily to focus on our scaling our revenue perspective. You say about 4x in last 1 year to about 10x in next 1 year. We are looking at about 10,000 scooters by March. Currently, we are doing about 2,000 scooters a month. With this fundraise, we are hopefully going to achieve surplus about 8 to 9% on the market share. From about today, we are about 1%. So this will give us a good edge on our entire plans that we have going forward. And the next milestone, I believe, is a 10,000 scooter milestone for our next fundraise, potentially a very large one. And hopefully that we have a better, competitive advantage on the valuation as well.
Suhas, just a clarity, you said the revenue has jumped 4 times, in FY26. Your monthly sales are around 1,500 or now, like you say, around 2,000 scooters a month. What really drove that kind of a jump in revenue? And going ahead, as you get to this 10,000 mark, what would the revenue growth look like?
So the 4x jump is primarily because we scaled from 10 stores to about 100 stores today, in active about 80. So by March, we should be about 150 odd stores, and this will drive a larger revenue growth. So about 10,000 scooters, we should be clocking roughly about a monthly revenue of roughly about 150 odd crores. That's our revenue target per month basis. From what today we have about 30 crores. So that is a significant jump from the current path that we are going up. And the entire fundraise will help us scale our production, our dealership network, and etc. So that we can suffice the market demand today. And given how we have scaled it is primarily due to our growth plans in retail network and nothing else. So I think as long as we continue to grow our retail network, our revenue will keep growing. And we are at a small base today. At a 100 store base, we will have exponent jump in our revenues. I think plus 500 stores, we should see a correction in the growth. And I think then we will have a CAGR of roughly about 60-70% month on month rather than 1x, 2x jump every month.
Okay, but Suhas, just help us understand. You're doing 1,500 to 2,000 scooters a month currently. In the next 9 months, by March of 2027, you want to get to 10,000. What's going to drive that kind of growth? You're talking about increasing the number of stores you have. That's one part of it. The capacity currently is about 3,000 scooters a month of production. At what pace will you ramp that up? And what's really going to get you to that 10,000 number?
So today our demand is upwards of 2,500 scooters, roughly about 3,000 if I have to put an exact number to it. Our production capacities limit us to a certain extent. Plus addition of dealer network will definitely enhance our growth. But again, we have our family scooter launching up, which is more affordable than what we have today. I think that will drive a larger growth there. And we hope that our ramp up in our capacity, which is roughly about 15,000 in capacity, and sales about 10,000 by March will be largely driven by our family scooter, which is around the corner. And the current portfolio of the platform will definitely add value. And we should scale it about to 5,000 to 6,000 scooters a month. And rest of it will come from our new platform that we are around the corner to launch.
Family scooter, of course, River, I believe, has been working on something more utility-based. Ather has Vista. Are you thinking of something along those lines? And, these are players that have already moved in that space. So what will be your competitive edge? And also, more importantly, what happens to your EBITDA break-even with all these investments you're making? And, how important is profitability as a priority, especially ahead of that IPO you're targeting, I believe, in FY28?
If you look at the history of Simple, we've always been conservative on our expenses, especially in our workforce, etc., and the fixed costs. But apart from that, if you look at our product strategy, we've always had an edge on technology. We've showcased, irrespective of range, performance, etc. On the engineering side, also we have done a lot of innovations, given how we have developed rare earth-free motors, etc. So I think we'll always have this competitive advantage on the product placement, first of all. And with the competitor rising up with their stakes, I think we are poised to place ourselves in a very comfortable position given the market feedback that we have gone with Simple One. We believe that family scooter will also have the same advantages, which market has not seen till date. Even on the utility side, we have done a lot of innovation on our family scooter, which is due to launch. And with regards to EBITDA and other aspects of the business, I believe we are on a positive path on achieving that. And hopefully we should be the first company to show a very good business model on the EV side, even at a smaller scale. So we are very strong on that. And I think it's all about discipline in how you kind of navigate those challenges and curtail your cost given what your goals are to achieve. And we believe to achieve a certain number, we have certain fixed expenses, and we are following the same metric.
All right. I mean, talk to anyone in the market with the rising fuel prices every day. I guess EV is the way to go. So, Suhas, we wish you the best with your plans and hope to have you back as you, realize some of these ambitions you've set for yourself. Thanks very much for your time here today.
Thank you so much.
On the hot seat today, Orange Health Labs is looking to disrupt India's diagnostics market with a simple promise: faster, more reliable testing. The health tech startup says it has ended FY26 with 138 crore rupees in revenue and 180 crore rupees annualized revenue run rate, while maintaining a 65% growth for the third consecutive year. Now, the company has also hit key profitability milestones, expanded its physical footprint to over 75 collection centers, and is now betting on technology and preventative healthcare to drive its next phase of growth. So what's fueling this momentum and what does the road ahead look like? Joining me now to discuss this further is Dhruv Gupta, the co-founder of Orange Health Labs. Dhruv, thank you so much for taking time out and being here with us on Startup Street. As I pointed out, you've reported this 138 crore rupees in revenue and exited FY26 at 180 crore rupee ARR, and you've maintained the 65% growth rate for 3 years, right? Talk to us about what's driving this growth and how sustainable is this trajectory going forward?
Absolutely. First of all, thank you for having me here. So the Indian diagnostic market is extremely large. It's about $15 billion. So if you think about it from a rupee perspective, that's like, it's like over 1.2 lakh crore rupees, right? And growing about 15% year on year. So we're in a market that has extremely strong tailwinds, right? We're in the top 4 cities of India, which actually contribute about 25% of the market. The top 10 cities contribute about 45% of the market. So the urban centers of India are actually extremely large markets in themselves. So for us, we today operate in the top 4 cities of India, which is Bangalore, Delhi, Bombay, and Hyderabad. Even today, I mean, even though we've grown, at 65-70% year on year for the last few years, and we expect to hold this space. We actually see that there's a very large opportunity ahead. Just in these cities, I mean, last few years we've grown just in these cities, but this year onward we actually plan to grow to more cities. So there's a large market ahead. It's actually the consumer market today, even healthcare for that matter, is looking not just for they're looking for convenience. Availability was what drove the last wave of healthcare growth over the last few decades. Now the consumer has availability. What they're looking for is convenience. They're looking for reliability. They're looking for extreme for things to be available at their need.
Absolutely.
Versus they're not driven by discounts. In the consumer healthcare market in urban India. So that's really the sort of trajectory that we're going after. This is the market that we're going after. And, in the last couple of years, we've also gone, like you're highlighting, from just purely digital to physical. Now
Absolutely.
we're completely omnichannel
And you know,
company.
we're going to decode that. And as you pointed out, everyone is looking for convenience and people are willing to pay a premium for that as well. And I saw so many articles that's calling you the next Zepto, the next Instamart for healthcare, right? In terms of all of these services that you do have. But before we get into that, many healthcare startups have struggled to balance growth and profitability. You've achieved this 20% EBITDA profitability in Bangalore, operational profitability across the other cities. What has been the key to getting the unit economics right? If you could quickly tell us, because we're running out of time.
Absolutely. I think what's key for us is that we've focused on ensuring that growth is not just driven by paid marketing. We focus very deeply on driving organic word of mouth for our brand and driving a very strong referral system, which is really how healthcare brands are built, right? Like it's very hard to just advertise and have someone trust their health on someone new. So focusing on extreme delivery of the service, ensuring that like the 99th percentile of customers have on-time sample collection. This drives a very strong word of mouth, ensuring our reports are high quality, timeliness, professionalism. These are actually have been the key facets for a strong word of mouth, which gets augmented by us by doing marketing over and above that.
Sure. And can you break down the revenue mix for us then? How much of it comes from at-home diagnostics, walk-in centers, subscriptions like Orange One, and your clinic partnership? So what's the revenue mix now? How do you want it to be going forward as well?
Got it. Look, our retail business has been relatively new. We only launched it, about less than 24 months ago. So today, about 90% of our business is driven by at home. About 10-11% is driven by our centers. But our centers actually become our fastest growing revenue channel in the last few quarters. So we expect this to become a significant contributor to our business. But the at-home market in itself is growing very fast. So both these sort of channels are in fast-growing markets from that perspective.
Sure. And you've expanded from 15 to over 75 company-owned collection centers. What does the next phase of expansion look like? More cities, deeper penetration in existing markets, or new healthcare offerings?
Yeah. We're very deeply focused on being a diagnostic company. So, and we see a significant opportunity in just going deeper in this market itself. Today we just do pathology. There will be opportunity to expand into categories within diagnostics itself. That's one. The other is the markets that we're in. Like I said, these are extremely large markets, with opportunities for us. So, along with deepening into existing markets and strengthening our core markets itself, we will be expanding to new markets. So we see both of these as large opportunities, and we'll be using an omnichannel approach across, which helps us drive significant brand visibility, trust, as well as servicing capability.
Absolutely. Until date, you've raised around $50 million. Do you have plans to raise more funds, or do you think you're well capitalized now for the next phase of expansion?
Yeah. As of now, we're pretty well capitalized, because we've been able to maintain financial prudence while growing the company. So that's helped us in being conservative and maintaining a healthy runway for ourselves. But like you highlighted, we're backed by some of the world's top investors, whether it's Y Combinator, seeded us, to Accel, to General Catalyst, Bertelsmann, and most recently our last round was led by Amazon. So we're backed by good folks who are actually, and whenever the need is for us to raise money, we always have the capability of doing that.
Absolutely. All right, Dhruv, thank you so much for joining us on the show, and we wish you all the best on your journey.
Thank you so much.
And on that note, it is time for us to head into a short break. But coming up next, quick commerce is changing the way India shops. But what does it take to get fresh fruits and vegetables from the farm to your doorstep in just minutes? We take you behind the scenes of one of the country's fastest growing grocery supply chains. More details on the other side. Stay tuned.
Welcome back. You're watching Startup Street. Now, India's quick commerce market is growing fast, and the race to deliver fresh groceries in minutes has never been more competitive. But behind every 10-minute delivery promise is an infrastructure that most customers never really see. CNBC-TV18's Aishwarya Anand went inside Amazon's grocery farm-to-fork supply chain, from a farm in Maharashtra to the fulfillment centers, keeping that promise. Here's a ground report.
You've probably ordered groceries on your phone this week. Maybe fruits, maybe vegetables. You picked them, paid, and expected them at your doorstep, fresh within the hour. But have you ever stopped to wonder where exactly that tomato was 48 hours ago? I'm standing on a farm in Narayangaon, Maharashtra, about 150 kilometers from Mumbai. And what's growing around me right now, these mulberries, these mangoes, could be at your doorstep in Bandra or Bengaluru by tomorrow morning, ordered on an app, delivered in minutes. Amazon calls it farm to fork. I call it one of the most complex logistical promises in modern retail. And today, I'm going to find out if they can actually keep the promise. Shrikant, help me understand this, that if somebody in Bombay is placing an order on Amazon now or Amazon Fresh to get fruits or vegetables delivered within minutes or within an hour, what is the actual chain of events that has to go absolutely perfect for that to happen? Because from where I'm standing, it almost looks impossible to me.
And this is actually where it starts.
Yeah.
Right? We have farmers who harvest the fruits and vegetables, and they do a quality check at their own end first, then bring it to our collection center. In the collection center is where we actually buy the produce from the farmers. We settle their payments within 4 hours. From our collection center, we transport the products to a processing center. From the processing center, we ship the products to a micro fulfillment center, which is closer to a customer in the city, from where you place an order.
What if a produce does not meet up to Amazon standards, and some inevitably won't?
Sure.
What happens to it, and does a farmer have to absorb the cost of it? And if they do, what happens to those who do not have a buyer lined up? What is the fair equation that you make on that front?
So as I was saying, when the farmer comes to our collection center, let's say they brought in 70 punnets today to the collection center, of which maybe 20 are not meeting a quality standards for the sake of conversation. The 50 are bought and the payment is settled, right? The remaining 20 are returned to the farmer there itself. And this is, typically around 10, 11 in the morning. So the farmer still has the entire day to look at alternative channels that they can sell that through.
What you saw was just the beginning. The farm, the farmer, the harvest. But a mulberry picked in Narayangaon at 8 in the morning does not simply teleport to a flat in Bandra by noon. Between that farm and that doorstep is a system. A grading line, a cold chain, a network of fulfillment centers, and algorithm that most of us will never think about when we tap order now. Now, I'm here at the collection center in Manchar. This is where Amazon's supply chain stops being about farming and starts being about engineering. You're using AI, you're using machine learning. I mean, are you still depending a lot on human judgment to understand, or is it actually helping you with that predictability of shelf life period right now?
So right now, the way it is in this space, we've learned at what stage in the life cycle of a crop or a product, what has to happen. So we will, for example, get some bananas from our farmers. And based on the stage of the life cycle of the banana, our systems will help us determine whether it should go to Amazon now for instant purchase or Amazon Fresh for a little bit later purchase.
The final stop in this chain is the one most visible to the customer and the least understood. Amazon Now's micro-fulfillment centers are compact facilities, typically between 3,000 and 10,000 square feet, positioned within 2 to 3 kilometers of the neighborhoods they serve. Each maintains temperature zones ranging from -18 degrees to 22 degrees, ambient, chilled, and frozen. There are more than 360 of them operational today. The target, 1,000 across 100 Indian cities. The company is currently opening 2 new ones every single day. India has one of the world's most complex, most chaotic, and most deeply human food supply chains. Millions of small vendors, local mandis, neighborhood kirana stores, a system that has led this country for generations without an algorithm. What Amazon is building here is faster, more measurable, and more scalable. But faster and more measurable has a way of making things invisible. The farmer's negotiation, the vendor's relationship, the kirana owner's livelihood. The 10-minute grocery promise, impressive. The question worth asking is, impressive for whom and at what cost? Well, this is Aishwarya Anand with camera person Balbir Singh for CNBC-TV18.
And with that, it is a wrap on this edition of Startup Street. From Ritu and me, goodbye and many thanks for watching. More news and updates continue right here on CNBC TV18.